So today we are having with us very dignified personality, CA Chetan Daga sir. He is qualified MCOM chartered accountant. He is also co-founder and practice lead at Advantage Group. He is specializing in direct taxes, transfer pricing, and regulatory advisory. He has been completed certificate certificate course in international taxation from University of Leiden, the Netherlands. Coming to his professional aids, he was felicitated by the Speaker of Parliament of India for distinguished academic performance. He has secured all India rank third at CA intermediate examination with 90 marks in accounting, the dream of many people. He has also secured all India rank 27 in CA final examination and secured third rank at Pune Divisional Board at higher secondary examination, that is 12th standard. So it is really big achievement, and we are really fantastic. We're really privileged to have such a fantastic speaker with us. Speaking about his work experience, he has been associated with several small and medium enterprises as tax and commercial advisor, associated with the World Bank on ease of doing business service, invited by the OECD to write a paper on a legal framework for social economy of India, author of a book, Fundamentals of International Tax and Transfer Pricing, and Indian Perspective, and co-author of a book, FAQ on Tedious Procedure, published by Bombay Chartered Accountant Society. We are really privileged and great to have such a fantastic speaker with us, and I am really proud enough to share with you that Chetan Daga sir belongs to Satara, and it's हमारे speaker को यहाँ पे बहुत, and we are really greatly privileged. I welcome you, Chetan Daga sir, to this fantastic tax audit series. Now I request you to take the charge and carry on the session, please. And before going forward again, I would like to repeat, presentation will be shared by today evening in the Telegram channels. So please be patient with this. Thank you. Over to Chetan sir.
Thank you, Hrishikesh. Thanks a lot for organizing this seminar. I was just sharing with Hrishikesh yesterday privately that the timing could not have been better. All of us are just out of the 31st July due date and about to start our tax audit. So it's always helpful to have a session, a refresher one at the start of the tax audit session. What we are going to cover today is basically discussion on some of the key clauses of the tax audit report. I will be sharing a copy of my presentation, as Hrishikesh mentioned, towards the end of the session. So only one request to all the participants: whatever is there, whatever is coming up on the slides will anyways be available to you. So let's have our complete focus and energy on the discussion at hand. I will be monitoring the chat box from time to time. So if anybody has any questions, or if there's any question put up on the slide and somebody wants to share a perspective, feel free to do so in the chat box. With this brief introduction, I'll start sharing my screen so that I can put up my presentation. Yeah. Okay, if somebody can confirm in the chat box if my screen is visible.
Yes, sir.
Thank you. All right. So without much ado, let's start with this fascinating subject of tax audit. There are a number of misconceptions around what exactly a tax audit is, and therefore each one of us has our own view or own perspective of what does the tax audit stand for. Many times it's driven by the client also. Sometimes even clients are not very clear what tax audit means. So in many cases, tax audit actually starts with year-end accounting and ends up with filing the income tax return, and then the entire process is actually called the tax audit. Logically, it's not true. Tax audit in its right spirit and right earnest means a number of things. Now, when we discuss about any topic in tax, when we start the discussion, a lot of things look very straightforward. And as we deep dive into the subject, we look at the intricacies and then we realize the complexity of the subject. So this is typically what we see. The expectation from us or the expectation of the client also is that tax is very straight. But when we look at the interpretations, when you look at provisos, explanations, amendments, subject to this, provided that, we look at the case laws, and then it all becomes jumbled up. Thankfully, on the topic of the tax audit, Institute has come out with very, very strong and robust guidance. It's largely comprehensive. And I'm also told that, the guidance note on tax audit is in the process of being revised. So at the outset, wherever there is any doubt, more often than not, you'll find some suggestion or a guidance in the Institute's guidance note on tax audit. Let's come to some basic aspects. This is typically how everybody looks at the tax auditor, right? I mean, we've been hearing a lot of things, government raising concerns that audits are not being done properly, income tax department being dissatisfied with the quality of the report. Client feels they're paying a lot of tax, or the chartered accountant is making them do too many compliances or asking too much of an information. So much so that even the tax auditor is now started to has begun to question himself that what exactly am I doing when I'm doing a tax audit. Fundamentally, what a tax audit is, it's nothing but outsourcing of certain functions by the tax department. This is something which the income tax officers should have looked at the time of the assessment, but they have outsourced a part of that responsibility in the spirit of partnership with the CA profession, where chartered accountants, being expert on the tax law and being expert in the auditing procedures, they should look at certain matters and give certain information ready-made in the hands of the tax department. And that is where a fundamental aspect here is, whenever we are doing a tax audit, we actually have to step into the shoes of the assessing officer to determine what are our reporting responsibilities and reporting obligations. It's of course a critical document at the time of the tax scrutinies. As much as the department would ask for financial statements, they would also ask for the tax audit. First and foremost, what does a chartered accountant certify when we certify the tax audit report? And this is where it's very different from a statutory audit report. In a statutory audit report, we certify that the financial statements are true and fair. Whereas in case of a tax audit, we are certifying true and correct. The difference between fair and correct gives very limited elbow room to the chartered accountant in terms of his reporting obligations. Because we are stating that the particulars are essentially correct, we are actually vouching for the accuracy of the particulars in Form 3CD. That makes our responsibility that much more significant and that much more detailed while certifying the tax audit reports. One misconception: people feel tax audit is done, so my tax return is done. That's not true. While the tax audit report is fairly detailed, the reporting requirements are fairly detailed, they are still not comprehensive. There are a number of items which impact the tax return, but which are not covered within the purview of the tax audit report. I have given a couple of examples on this slide, but the bottom line is, while tax audit report will give you a coverage for most of the items that impact the tax return, still there would be certain items which do not appear in the tax audit report, but which may still have to be reported or reflected onto the tax return. Next, tax audit report does not bind the SSE. It does not bind the tax department. So today, as a tax auditor, you have taken a particular position. Nothing stops the SSE from taking a different position when he's filing a tax return. Of course, the position or the difference has to be justified. But if there is an interpretational difference, or if there's an approach difference, as a tax auditor, you may report something. The SSE is free to choose a different position in his tax return. Similarly, in the course of the scrutiny assessment, while the tax department makes use of the tax audit report, legally, nothing in the tax audit report binds the income tax department. So, for instance, you have certified that the depreciation allowable to the SSE is 1,000 rupees. Nothing stops the department from inquiring that why the 1,000 rupee depreciation should be allowed. Yes, an initial level defense can be taken that the depreciation working is as certified in the tax audit report, but it's the department's prerogative whether they want to rely on it or they want to do their own independent verification. Lastly, the tax audit report or the audit under Section 44AB is an audit of business. It is not the audit of an SSE. Now, in a corporate scenario, when you're auditing companies, where you're auditing firms or LLPs, it doesn't matter. I mean, there are no personal elements involved there. But when you're doing a tax audit for an individual, it is very important to separate out his business transactions from his personal transactions. If you look at the design of the tax audit report, most of the clauses are focused on business activities. Though maybe because of certain situations, certain personal elements have gotten involved or embedded into the Form 3CD. At the core, tax audit report still remains an audit of business. SEC's personal transactions have nothing to do with the tax audit report unless there is a specific question being asked in the tax audit report from a reporting perspective. Anything that you report in the tax audit report does not result in automatic disallowance of expenditure. We've already seen that the particulars in the tax audit report are not binding on the SEC. So it does not automatically result in the disallowance. While that may be so, when the returns are being processed under the electronic system, the CPC is taking an approach that wherever there are differences between the tax audit report and the tax return, they are flagging up those differences, and in almost all cases, they're proposing adjustments under 143(1). That's a legal battle which have to be fought before the courts. That whether a mismatch or whether a difference in the tax audit report and the tax return constitutes an arithmetical error for CPC to be empowered to make an adjustment under 143(1). Sooner or later, we will see some court judgments being cited on this issue. But fundamentally, tax audit report should not result in automatic disallowance of expenditure. Practically, because of CPC's approach, the situation is little different. Disclosure in the tax audit report will support the SEC in penalty proceedings. I'll cite one practical example here. So there was a reputed consulting firm which was making provision for gratuity on an year-on-year basis. It was unfunded gratuity. Now, that gratuity provision should have been disallowed in the tax return. They were consistently doing that. Every year, whatever was the gratuity provision, they were disallowing in the computation of income. For one particular year, they missed out in making that disallowance. Department picked up the matter in the assessment, and department said it is reported in the tax audit report. Department made that addition in the assessment proceedings. In all fairness, the SEC also accepted the addition, saying that yes, it was an error in the tax return. Thereafter, department proceeded to initiate penalty proceedings. The matter reached right up to Supreme Court. And before the Supreme Court, one of the strong arguments taken by the SEC was that I did not do it deliberately. And this was supported by the fact that the disallowance was already reported in the tax audit report. And Supreme Court very actively considered that yes, a disclosure was made in the tax audit report, and therefore, what was missed in the tax return was only a technical omission or only a human error. It was not an intentional mistake. Which brings me to a very important point. And we will discuss this when we come to the next slide as well. In terms of the forms, that within the tax audit report, what is the responsibility of the SEC vis-a-vis what is the responsibility of the tax auditor? At an approach level, three things we have to consider. Doing an effective tax audit requires us to have a proper understanding of the provisions of the Income Tax Act, because essentially it's an audit report under the Income Tax Act. But at the same time, it requires a sound understanding and application of audit procedures. And third, and equally important, documentation. We should have enough documentation available to justify the positions that are taken in the tax audit. Let's look at the forms. Form 3CA is an audit report where the books are already audited under any other law. Common example would be if you're doing a tax audit for the company's accounts are already audited under the Companies Act. So you will be issuing the audit report in Form 3CA. Where the SEC is not otherwise audited, typically individual and HUF cases, the tax audit report will be in the Form 3CB. And for both the forms, there is an annexure in Form 3CD, which contains information against the specific clauses. Now, the key distinction here is, as a tax auditor, you are the owner of Form 3CA or Form 3CB, because that's your audit report. But you are not the owner of Form 3CD. It is the SEC or the client who is the owner of Form 3CD. The scheme of the tax audit is The assessee fills up the 3CD. You as a tax auditor verify the 3CD and report the particulars in form 3CA, 3CAP as the case may be. And this is where I go back to the earlier case of the consulting firm that I spoke about, the penalty proceedings. Because the 3CD belongs to the assessee, anything that is disclosed in the form 3CD is a disclosure by the assessee and commented upon by the tax auditor. Now, practically what happens, clients do not understand 3CD. So, the tax auditor ends up updating the data in 3CD. That may be a situation on the practical side, but legally speaking, 3CD is the ownership of the client. You're only commenting on 3CD when you are issuing 3CA or 3CB. There are 44 clauses in Form 3CD. Clauses 1 to 8 deal with basic information, and then thereafter there are some specific information. With this background, let's look at some of the important clauses of the tax audit report. Certain clauses which may not really apply to a wide range of people, I have omitted those. Certain clauses I'm not very sure whether they will apply to a large section of people, so I've put them up for the sake of completeness. But depending upon how we are doing on the time, I may touch upon them, I may not touch upon them. Okay, one traditional question. Whenever you are subjected to something, the first question comes is, what happens if I don't do it? Right. So if you don't get the tax audit done, if the client does not get the tax audit done, there is a penalty, 0.5% of turnover, or 1,50,000 rupees, whichever is less. Now, we had a client asking us, saying that, oh, I don't have the data ready, so forget it, I'll not do the tax audit, I'll simply pay the penalty. So instead of paying the chartered accountant a lakh of rupees as professional fees, I might as well pay the penalty. Well, it's not an option. It's not the case that you pay 1,50,000 as penalty and then you don't get the books audited. The obligation to get the books audited still remains. But if you don't get it audited in time, you are exposed to penalty. And there is a saving clause. Sorry, I'm getting a message in the chat box that the audio is not coming through. I would just like to confirm.
It is audible. I think Diksha might be...
Okay, maybe it's a person-specific issue.
Yeah, she would require to join again.
Okay, all right. Fine. Yeah, so that was the case of penalty. Of course, penalty under 271B is subject to 273B, which basically says, while there is a penalty for not getting the books audited, as an assessee, if you can prove that there was a reasonable cause which prevented me from getting the books audited, then penalty will not be levied, but the burden of proof is on the assessee. The assessee will have to prove that yes, he was prevented by a reasonable cause. This was something sent to me
Can
by
I ask one question?
Yes, please.
Have you practically seen anybody getting this late fees penalty?
Yeah, very often. Very often. We have seen many such cases. At least I would say in the last 2 years, we would have at least filed no less than 20 appeals for tax audit.
Okay, sir.
And in fact, it's a very interesting question, Hrishikesh, you asked, because very often, right, as practitioners, we get a question from the client. Really, आप इतना देख रहे हो, सच में डिपार्टमेंट देखता है क्या इतना? इतना सब दिखाने की जरूरत है क्या? So what I have put up on the slide was something sent to me by a very senior tax official. I thought it was very relevant for the conversation. So, department knows everything. By and large, they know everything. It's just that they don't have resources to look at everybody, right? We are a country of 135 crore people. So naturally, they do not have the bandwidth to look at everybody. But sooner or later, yes, department will track each and every transaction that's happening. Let's now come to some of the key clauses. Clauses 1 to 8 are very generic in nature, which talk about name, status, previous year, assessment year, so on and so forth. There is only one clause that I would like to touch upon there. There is a clause for address of the assessee. Why I'm bringing this up? Because in June 22, Institute came out with a study report on observations on the tax audit report. And one of the observations from the Institute side has been that the address that have been entered on the tax audit report does not match with the registered address of the SSE. So this is one of the findings of the Institute. So only with respect to that finding, the takeaway from my side is the address on the tax audit report should be the address either of the registered office wherever applicable. In individual cases, it should be address as per PAN records. Now, many times we observe that clients have changed addresses, but the address in the PAN record still remains the same. The logical approach there is that the client should apply and get the address change in the PAN records rather than we changing the address on the tax audit report. But as things stand today, when we are certifying, we should certify based on the address in the PAN records. Clause 8A, concessional tax regime. There are 5 concessional tax provisions, section 115BA series. 3 of them apply to companies, 1 applies to individuals, and 1 applies to cooperative societies. The question in the audit report is whether the SSE has opted for any of the concessional tax regimes. In the next slide, I have given you the details which you can refer whenever you would feel the need. But the essence of these provisions is that each of these concessions come with certain conditions. For instance, if we talk about concessional tax regime for individuals, you are taxed at a lower slab rate, but then you do not get the benefit of any Chapter 6A deduction. Most of the exemptions in Section 10 are not allowed. So it's a trade-off. You give up certain exemptions and deductions and you are taxed at a lower rate. All these provisions are optional. So every SSE has to take a call whether it makes sense for him to continue the way he is or should he opt for the concessional tax regime. And wherever the SSE wants to opt for the concessional tax regime, there is a positive act required from the SSE. That is, the SSE has to file a form and declare to the department that, yes, I want to be governed by the concessional tax regime. These forms have to be filed before the due date of filing the return. In certain cases, they have to be filed for the first return which is available once the scheme is coming to operation. In certain cases, whichever year you want to opt for, in that year you have to file a form. Most of the provisions say once you opt in, you cannot opt out. Again, with the exception of individuals, if you have opted in, you can opt out, but you cannot opt in again if you're a business SSE. What is our responsibility as a tax auditor? It's only a factual question whether the SSE has opted for taxation under these provisions. How do we know that? The answer is simple. We have to ask the SSE. We should collect the relevant forms that are filed with the department as a proof that the SSE is opting for these provisions. And we should take a representation from the SSE to this effect. Now, in certain cases, SSEs have opted for concessional tax, or so they claim, but CPC for some reason has denied the benefit of the concessional tax. Now, in that scenario, what do we do as a tax auditor? The SSE claims he has opted, CPC claims he is not eligible for whatever reason. The point of inquiry there has to be, okay, there's a question, what is CPC? CPC is the centralized processing center. All the tax returns, all the tax audit reports that are filed or electronically uploaded, they are centrally processed by the tax department's cell in Bangalore called as Centralized Processing Center, CPC for short. So when in the situation like this, SSE claims that he is opted for concessional tax regime and CPC or the income tax department says, no, we are not granting that benefit. What we need to do as a tax auditor is we need to inquire into the reasons. If it is an interpretational difference, we go back to the question. The question is whether the SSE has opted for it. It does not say whether the SSE has opted and the tax department has agreed. So long as it's an interpretational issue and the SSE has opted for it, we should continue to certify that the SSE has opted for it with a suitable note or a disclosure in the tax audit report, citing that, okay, SSE has opted and income tax department has basically denied this. Okay, this is a question. Why can an individual not file his or her return on his own? Well, besides the topic, so if there are any questions which are relevant to the tax audit, we'll take them. Such questions we can take offline. So that's on the concessional tax regime. This slide is a chart. I'm not taking you through the details of the chart, but this is a good referencer to anybody who wants to look at what are these concessional tax regimes. Coming to clause 9. What do they ask? If the SSC is a firm or an association of persons, give the names of the partners and their profit sharing ratio. And if there is a change in the partners or their profit sharing ratio, give details of that change. So two things. Who are the partners and what are their profit sharing ratios? And second, if there is a change in the profit sharing ratio, or if there is a new partner coming in, some partner retiring, disclose that aspect. Now the question is, why is this information asked for? There are 3 reasons why this information is asked. First, calculation of allowable remuneration. Now, in case of a partnership firm, there are specific provisions that to what extent the remuneration paid to partners is allowed as a deduction. Now, if somebody who is not a partner or who's not a working partner cannot be given remuneration, so department wants to collect that information and correlate it to examine whether whatever deduction has been claimed is legitimately claimed. Second, there is a provision for change in constitution of the firm, which basically says that, if there are any changes in the partnership structure, the change structure or the structure that exists at the time of assessment will be used by the department to check on the allowances, disallowances. And third, there are these new provisions called 43C, 45.3 and 45.4, which deal with taxation at the time of retirement or dissolution of a partnership. So the income tax department only wants to collect information that something